Well, hi there. So in this video, we're going to be talking about central banks. It's the only lecture about central banks that we're going to have. And a little bit of this is like just kind of some wonky technical details. And then some of it is like super really important stuff. And I'll try to point that out to you. And again, this is the third topic in our financial sector unit. So let's get started. The very first thing, and I point this out in class, is these are the last five chairs of the Board of Governors of the National Federal Reserve System, right? The National Central Bank of the United States is kind of different, actually, from a lot of other central banks around the world. Our central bank in the United States is actually really decentralized. It's got members that are both private and partnerships with public. And the chair isn't like this all-powerful guru, but they're often the face of the Fed. And they're by far, their voice carries a lot of weight in what the central bank does, and especially how it really relates to monetary policy, which we'll learn about in this video. So I just kind of give you the last five very quickly. This is Paul Volcker, just a legend in monetary policy, really important in terms of solving the stagflation crisis of the 1970s. And the guy to his right, the other old white guy, is Alan Greenspan, and he was president of, or he was the chair of the Fed for a really long time. Most of my childhood and most of my adulthood, in fact, he was the chair for a really long time, presided over a period of real economic stability. And a lot of people credit his leadership with that. The third individual, Ben Bernanke, a scholar of economic history, he was the chair of the Fed during the financial crisis in 2008. He was really important to essentially saving the world economy, right? So just kind of think about how important these people are. That was the man in the room where it happened, Ben Bernanke. And the person to his right is Janet Yellen. And Janet Yellen is notable because she was the president of the board, or she was the president of the San Francisco Fed for a long time. But she's also the first female chair of the Federal Reserve System. And she was appointed by Barack Obama in 2014, and she served as chair until 2018. And she now serves as the first female secretary of the United States Treasury, which is kind of like basically it's not the central bank, right? The Treasury of the United States is basically the one that pays the US government's bills and collects the taxes and provides a whole host of other important things. So she's really an amazing person, a brilliant economic scholar as well, in addition to just being a real trailblazer for women in economics. The person on the right is Jerome Powell. He's currently the chair of the Federal Reserve System as well. And so he plays an important role in our management of the financial crisis, this pandemic, right? So the last five chairs of the Fed have each played an important role in stabilizing our economy and being people kind of behind the scenes who are making sure that the wheels don't fall off and that when our system is threatened, these people step into the breach in truly, really heroic ways, in ways that we don't know, that are really large and small, and really trying to keep our country safe. So really very important individuals in that way. So let me talk broadly about what central banks do, and this is true for not just the United States, it's true for all central banks. Central banks are generally government financial institutions, so they're parts of government, but typically they're independent of the rest of government. You don't want politicians mucking around in central banks. And that's because these central banks are given privileged control over the production and distribution of money and credit. And that means that these are the people who decide how much money there is in the system. So we don't usually let politicians make that decision because the temptation is really strong to create more money and solve your problems. And that's not good. So we usually have really technically minded folks who are willing to do that. They also do a lot of regulation. So, responsible for the formulation of the monetary policy about how much money are we going to have. They do a lot of regulating of banks and the financial system. Beyond just banks, there's all kinds of other institutions that central banks are in contact with, and they try to create stability. And the central bank of the United States actually has basically five things that it functions to do, and it has a mandate to do two things in addition to it that I'll talk about in a second. So the five functions of the Fed are quite simply conduct monetary policy. And this means, right, manage the money supply. And that's by far the biggest function of the Fed. The other things are promoting stability in the system, the whole system and network, promoting stability of individual financial institutions. So like if Bank of America or US Bank or PNC or any number of these things, if they get into trouble, the Fed's job is to help them stabilize. In addition, they stabilize the payment system. And this seems weird, but the Fed is actually in charge of check processing. And it should make sense because actually the central bank is the banker's bank. So every bank mostly has bank accounts with the central bank. And so if you were to write a check and you use PNC and somebody else uses Bank of America, how does the money go from PNC to your destination of Bank of America? Well, the Fed facilitates that. So they actually, all the checks kind of go through that. And it's fairly easy because the Fed has bank account for PNC, bank account for Bank of America, boop, 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 and they move the money over. And the last thing they do is they promote consumer protection. They try to ensure that nobody's going to scam people. They really try to, they regulate people's behaviors in terms of financial markets. And there's lots of regulations that they do, again, to try to protect ordinary households. So lots of important things that they do. I mentioned that they have a dual mandate, and their mandate, right, this is actually part of their job, and Congress said this is their job, is to promote full employment, right? Full employment. And we know what that means. It's true of both people with jobs, right? Their job is to make sure the unemployment rate stays low and stable. And it's about output, right? Making sure that we're fully using our capacity. And the second element is stable price levels, right? So their job is to control inflation, and their job is to control employment. And they can't really directly affect either of those, but the things that they have in their toolbox can absolutely change those two things. Now, where the Fed gets into trouble, and this is actually, Fed people will tell you that they struggle with this, is that usually there's a trade-off between these two things. You can really work on one of them and the other one can get out of control. Or you can work on one of them and the other one can get out of control. It's really hard to do both. In fact, no other central bank around the world is mandated to do both. The vast majority of central banks around the world, their only job is to make sure prices stay stable. So the European Central Bank, Bank of Japan, the People's Bank of China, actually PBOC, I don't know that, I think that's a regular, I don't forget what the Bank of China is. It might be the PBOC. But all those other central banks, their only job is maintain price levels. So the Fed has a dual mandate. It makes it a little harder. Now, Jerome Powell is still going to watch us for the rest of this. Now, they have tools in their toolbox to accomplish this mandate, to conduct monetary policy. That's what we're going to learn next. So each one of these, conducting monetary policy, is about changing the size of the money supply. So you can see that in this next section, it's going to say decrease money supply, increase money supply, decrease money supply, increase money supply, increase, decrease. The point of changing the money supply is what we'll get to at the very end, right? So you've got this tool number 1, this is tool number 2, and this is tool number 3. And they're the same ones that are up here. So you can see required reserves. This is reserve requirement. Discount window, right? Discount window rate, right? Down here, sell and buy bonds. This is the idea of buying and selling bonds. And the whole goal is going to be that we can change unemployment and we can change price levels through doing those things. So that's how they're going to achieve their mandate, is through managing the money supply. So that's kind of where we're going here. Now let's talk about those 3 tools and what they look like. Oh, I forgot. I put this slide in here because I didn't want to forget to tell you this. The Fed, this is not on the AP test, but it's actually kind of useful so that you know something about American society. So feel free to skip ahead to the next part if you just want the AP stuff. The Fed actually has 2 entities that are part of it. It's kind of a wacky little way that they've structured it. It's the only one in the world that's structured this way. There's a public part of it that's government controlled and government run. And then there's a private part that's actually run by banks themselves, the member banks that have bank accounts with them. So the board of governors is the part that's controlled by the government part. And it's a group of people who are nominated by the president and then confirmed by the Senate to very long terms of office. And the idea of this is that they get a voice basically on the big picture of regulations, and they get a seat at the table in setting monetary policy, but they don't make the full decision. And by the way, these people are insulated from politics. It's very difficult to fire them. The president can't just fire them willy-nilly. They're on the board for 7 years. It's really long term. The other part are what we call the reserve banks themselves. And there's 12 of them all across the United States. Each one of them is its own thing, and it has its own president, and their presidents are chosen by the banks that are within that geographic area. So for example, the St. Louis Fed president, he is not technically really like an official US government employee. He's an employee of the St. Louis Federal Reserve Bank, which is a private bank that's kind of managed privately by member banks within the St. Louis region. Now, they kind of also have regulatory and financial services that they provide. And a lot of times the difference isn't really that important, right? They kind of operate as this quasi-governmental agency. But where the rubber meets the road is what's called the Federal Open Market Committee, the FOMC. And they meet regularly, and they have members. They are all the bank presidents of all those independent little 12 central banks, and they have representatives from the Board of Governors. And they sit down, they powwow together, and they talk about what should be the monetary policy, and they take a vote. Now, not every one of the central bank, the 12 independent ones, gets a vote every year. They rotate that, and they try to basically balance the number of publicly appointed people, the Board of Governors people, with private bankers' voices in monetary policy. So it's very decentralized, right? You don't have a politician just storming in and saying, we should create more money because I said so. It's really actually a very thoughtful, very smart group of people. And a lot of times, people get chosen to be board of governors members nominated by the president after they've been a Federal Reserve Bank president for a while. So like I said earlier, Janet Yellen is a good example of that. A lot of times they kind of move back and forth between those roles. Okay, so I thought I would mention that. That's like actually how they make the decision, is this committee of people that sits down and says, this is what we should do next. So these are the tools. I'm going to go through them one by one. Some of them are a little bit technical. This is where we get into really important stuff. So put a star next to this and be like, I got to know this. This is really important. The first tool is changing the required reserve ratio. It sometimes is called changing the reserve requirement. In the previous lessons, we learned that banks, when you deposit money, they have to keep a certain amount of money on reserve. And that amount of money that they have to keep on reserve affects how much money gets created by lending processes. So if the Fed steps in and says, hey, you need to keep more money on reserve, the effect of that is that it decreases excess reserves, and it makes it harder for the banks to loan out money because they have to keep more in reserve. So that decreases the money supply. So down at the bottom, we can say if they increase the reserve requirement, banks can't loan out as much, so that decreases the money supply. Now, if they lower the reserve requirement, in theory, that makes it easier for banks to lend out more money, and it makes the money supply bigger. So during the pandemic, in fact, in March of 2020, right when the pandemic hit, do you know what they changed the reserve requirement to? Take a guess. 0. So banks don't actually have to hold any of the money on reserve right now. They have capital requirements, which are related. And that means that basically they have to keep some cash on hand, but it's not the reserve requirement anymore. Now that could go back up again later. But what we found is that actually it's not a particularly useful tool because you can't force the banks to lend that money, right? So this tool used to be really valuable, but it's kind of actually gotten to the point where it doesn't really do very much anymore, because you can say, hey, banks, you don't have to lend anything. You don't have to keep anything. But if they don't lend it out, then it doesn't really do anything, right? Now, AP test world, this is definitely something to know, though. Now, the second tool is going to be called the discount rate. Now, if you read the modules, they talk about this weird little thing where basically banks want to keep a certain amount of reserves on hand, right? They would say to themselves, okay, you know, PNC, right? At the end of the day, PNC looks at how much money they have on reserve and they go, that's cutting it a little too close. We want more. It's possible that, you know, they want to hold like X amount of excess reserves, and maybe they dipped below that. The second scenario where that could happen is if they actually got below the required amount, right? And then they're really in deep doo-doo because they have to hold it. So what they normally do, their first phone call is they call up another bank and they say, hey, you know, if it's PNC, PNC says, hey, it's PNC, Bank of America, how you doing? Bank of America's like, hey, I'm doing all right. How you doing? PNC goes, I'm not very good. I got a problem. I need some reserves. And Bank of America goes, oh, you need reserves? We got plenty of extra ones. We could lend some to you tonight, overnight, just for the night to make sure that you're good. And PNC is like, oh, that'd be great. Thank you. I really appreciate it. They make a little deal in this overnight market. Now, with that deal, PNC is going to have to pay a little bit of interest to Bank of America. And that interest rate is going to be becoming important in just a second. But imagine in this little phone call, PNC is like, hey, Bank of America, we could really use some excess reserves. You got any extra reserves you'd be willing to lend us overnight so we can get to that minimum that we want to keep? And Bank of America goes, you know what? I don't trust you. No, no more, no excess reserves for you. Or potentially, they go, you know what, we're in the same boat. We got a big problem on our hands. We need some reserves. And they both call up somebody else and they can't get any. So what they go to is they go to the Fed and they say, hey, Fed, we need an emergency one-night loan. We promise we're going to get it back to you really quick. And the Fed goes, all right, no problem. We are the lender of last resort. We'll help you out. And it's called the discount window. It used to be like a teller window, actually, in the physical bank branch. You'd send a little runner, a kid, and they'd borrow the money overnight. Nowadays, it's all electronic. But we call it the discount window because originally, actually, the Fed would do that at a discount. The Fed would be the first phone call rather than calling another bank. Nowadays, the first phone call that PNC would make would be to Bank of America, another bank. But back in the old days, this actually was a really cheap way that banks could make sure they got enough reserves. Now, how the heck does this have to do with the money supply? I had to tell you this long, stupid story all about this. What does it do? Well, here's the deal. If the Fed charges a really high rate for that discount window, right, even though it's not really a discount, they'd say, oh, you're going to have to pay a really high interest rate for that. Then PNC, before they even get to the point of having to make the phone call, they're going to say to themselves, I don't know, if I get into trouble and I make too many loans and I don't have enough reserves, I'm going to have to pay this really high interest rate from the Fed. And that's expensive, and I don't want to do that. So a really high discount rate would have the effect of discouraging PNC from lending out too much money in the first place before they even got to making the phone call. Right? So that's why we include this part about like risk taking in here, that a really high rate would discourage the PNC bank from making a risky loan. And that has the effect of decreasing the money supply because they're less likely to lend out money. So if they increase the discount window rate, it decreases the money supply. If they decrease the discount window rate though, and they're like, you can call us up anytime. We're the Fed, easy money. You can have as much as you want. You don't have to pay very much. Then it's not very painful for PNC or whoever who's running short to go, hey, Fed, we could use some extra cash, right? So they'll make some more loans, and the effect of that is to make the money supply bigger, right? So this is all kind of that connection to like before they even had to make the phone call. So a lower discount window rate would make the money supply bigger through that influence. Now, the third tool is by far and away the most important one. The first tool, it's not that effective because you can't make the banks loan out the money, remember? The second tool, the problem is banks, and this, I'll tell you why the second tool doesn't get used very much in addition. The problem is when they go to the Fed's discount window, it's public. And so if you're PNC or Bank of America or whoever, and you go up to the discount window and you say, hey, Fed, I need some extra money. I can't meet my reserves. Nowadays, other banks know that your first phone call is actually to other banks, because nowadays the other banks actually charge a lower rate than what the discount window is. It's weird. It's dumb. It's a historical artifact. But other banks know that if you're PNC and you need a little extra cash, or you're Bank of America or whatever, and you need some extra cash, that if you're going to the discount window, the reason you're doing that is none of the other banks will lend you money. Now, banking is all about trust. It's all about trusting that you're good for your loans. So why, if you're thinking to yourself, oh, no one else is going to lend PNC Bank any money, ooh, what do they know about PNC Bank that I don't? So in fact, banks are really reluctant to use the discount window because it basically amounts to admitting that no other banks trust you enough to lend you money on an overnight market loan. And that means something's really stinky in your world. And in fact, during the 2008 financial crisis, there were banks that decided rather than even try to go to the discount window, they would just declare bankruptcy and call it quits. Because by going to the discount window, you're almost effectively saying no one else trusts me. And so you're basically cooked, right? Your goose is cooked. There's no reason for you to continue operating because everybody else is like, I'm not going to trust them. So people don't use the discount window anymore. It's not really, I mean, sometimes it gets used, right? In 2008, it got used a little bit. The pandemic, it got used a little bit. But generally speaking, people don't use it. Banks don't use it. The third tool, though, gets used all the time. And this is actually how the Fed changes the money supply. So the Fed can do what's called open market operations. So it's a fancy phrase, open market operations, or OMOs for short. Now, OMOs are how they conduct monetary policy to target what's called the federal funds rate. It's an interest rate, this federal funds rate. And remember when I told you that little story about PNC Bank calling up Bank of America and being like, hey, you want to give us a little loan, please? Bank of America's like, yeah, that's cool. We'll give you a little bit of money overnight. We got to charge you some interest, though. That's the interest rate. The interest rate that the banks charge each other is this overnight lending market. And this sounds totally shady and stuff, but it's not. I swear it happens every single night. They basically have to rebalance because people buy it and that kind of stuff. And so that interest rate that banks charge each other, the Fed tries to target that interest rate. And that interest rate is the reason they target it is because virtually every other interest rate in the economy is tied to that interest rate. If you were to go get a mortgage loan, it's going to be tied to the federal funds rate. And they won't tell you that, right? It'll say like your interest rate on your mortgage is 4%. But what that is the federal funds rate plus a certain percentage. And that's how virtually every other interest rate in the economy is determined, is off this one interest rate that banks that lend each other in this overnight market is. Now, the trouble is the Fed can't directly control that interest rate because remember, it's PNC and they're calling up Bank of America and Bank of America's like, yeah, that sounds good. Sure, I'll do the deal. A certain percent interest. So the Fed isn't really directly part of that. Well, what the Fed can do is influence it. And here's how they do it. They use open market operations. And this is how it works. The Fed can go to a bank, any bank that's a member, right? And in theory, there's about a dozen that they regularly do this with. And they say, all right, we want to make the money supply smaller, right? We want to drive up that interest rate and make the money supply smaller and push that federal funds rate higher. And why they want to do that, we'll see in just a moment why, but they want to mess with that interest rate. So what they're going to do is try to make the money supply smaller because then there's not very many reserves in the system, right? So think about it like if PNC called up Bank of America and Bank of America's like, oh man, we don't have very many reserves. We can't really loan them. Then it's going to push the interest rate higher because basically there's a higher demand and a smaller supply of excess reserves. That's what they're exchanging, right, is excess reserves. So what the Fed can do is they can say, hey, everybody, we would like to sell some government treasury bonds. Now, stay with me here. This is weird. The Fed has a portfolio of bonds that are U.S. treasury bonds, like actual U.S. debt, right? It's not money, it's debt. And the U.S. government, when it borrows money, it issues bonds, okay? Like, borrowed money, it's a loan. And eventually they wind up in the possession of the Fed. And what the Fed can do is it can go to a bank and it can say, we would like to sell you one of our bonds. Now, this is very difficult. So I want you at home watching this to imagine that you are the bank and I am the Fed and I want to make the money supply smaller. So I go to you and I say, I'd like to sell you a US government bond. So I hand you a bond, right? It's worth something, might be worth $1 million, right? $1 million worth of bonds. And I give them to you. And in exchange, what do I take? I take your reserves. I go, and I eat them up, right? And then I just delete them out of your bank account. I give you the bonds that are worth $1 million, and then I delete out of your bank account $1 million worth of reserve cash. So monetary base just goes a little bit smaller by $1 million. And I just delete it. I go, bloop, gone, because I'm your bank. I'm allowed to do that. When I sell bonds, I make the money supply smaller, literally just by giving you these bonds. So what we say is smaller, right? Sell bonds smaller. Now that's the little trick to remember it. Now the selling bonds, that's me, the Fed. When the Fed sells the bonds, it's going to make the money supply smaller because it deletes reserves out of the system. Now that has the effect of pushing that federal funds rate up because there's less reserves. So when PNC calls Bank of America goes, geez, the Fed just sold us a ton of bonds. We really don't have very many reserves left to let you have. So we're going to charge you a really high price for it. That pushes that interest rate up. So we can actually say interest rate goes up. And that's how it happens. Like that's what it does. And then throughout the rest of the economy, it goes and it ripples out. Mortgage rates go up a little bit. Credit card rates go up a little bit. Car loan rates go up a little bit, all around the economy, just like that. Now, what if they want to do it the other way? And you might be asking yourself, how in the heck did the Fed end up with the bonds in the first place, right? If I'm the Fed and I'm like, I want to sell you some bonds, where did I get them? I bought them in the same exact way. If I'm the Fed, I have agreements with banks that are my little pals, that they have their bank accounts with me. And I say, listen, you guys have to hold a certain amount of US government debt. It's worth something, so it's not bad to you. It's an asset, it's a bond, it's worth something. But whenever I need to, I might need to buy them from you. If I want to make the money supply bigger, I'll just go to my bank. If I'm the Fed, I'll go to my little banks. So that's you, your Bank of America, and I call you up. I'm the Fed, and I say, Bank of America, I would like to buy some of the bonds that are on your balance sheet. And you go, okay, sounds good. It's an auction, and it's kind of more technical than all this, but I'm simplifying for us here. And what happens is I'm the Fed, and I say, I'll take your bonds. Whoop. And I took your bond, right? I'm like, give me that bond. Whoop. And I put it into my little portfolio of bonds. What do I give you? I give you money. I just go bleep, bleep, bloop, and I create reserves. I literally just create money out of thin air, and I credit it to your bank account, like yours, Bank of America's bank account. And now you have more excess reserves, and you can loan that out. And that's how there's more money. It's really exciting. I love the part, especially in this story, when it's literally out of thin air. Like they buy the bonds and they make the money supply bigger. And what do they pay for those bonds with? They pay for it with newly created money. They're just like, out of thin air, have some money. Here you go. We'll credit your account. It's kind of wild. Like they don't, there's no like borrowing it from someone else or anything. Like they're just like, okay, we want to buy some bonds. Here's some money. There you go. Have some money. We'll take your bonds. Right now, the Federal Reserve Bank has trillions of dollars of bonds sitting in its portfolio. So at any time, if they want to make the money supply bigger, they could just go to their little bank friends and they say, banks, I'm going to buy more of your bonds and add them to my huge pile, and I'm going to give you actual money for it. And that's how that works, right? So that's the short and sweet of how open market operations work. I think it's really cool. But remember, I told you about monetary base and how bank reserves can be messed around with. That's how they do it. It's really neat. I love it. It's cool. All right, so let's go through this chart a little bit together. Now, the interest rate is the very first thing that's linked on here. Now, I don't want you to just immediately copy down this thing, but they are here if you need to pause it. But remember, the stuff that's circled down below in pink is the goal, right? Remember our dual mandate. So this is our goal, and this is how we get here. So if we have this money supply and we make the money supply smaller, it's going to push the interest rate up because it's literally a less supply. And think about this interest, right? Interest is the price of money. And so literally, if we say like the supply of something goes down, the price of it is going to go up. And so we can say the interest rate goes up, the interest rate goes up when we do those actions. If we increase the supply of something, though, as we learned in Unit 1, the price goes down. So the interest rate goes down. Now here's where the fun part happens, right? We learned this stuff already. It's just connecting the dots. And this is what I love about economics is like all the little pieces start fitting together. And this is one of those lessons. So I am so excited that you're here for this. I get really excited about this lesson. It's just so neat because all the little pieces fit together just perfectly. Anyways, sorry, I'm geeking out. If the interest rate goes up, then we know that consumption and investment spending is going to go down because it's interest sensitive. So people are going to be like, oh, I don't want to borrow as much. No, no, please, no. And so we can put down arrows. And likewise, if the interest rate goes down, consumption and investment goes up because people are like, woo, money is cheaper. I want to borrow some. Consumption and investment are components of aggregate demand. So they are literally a kind of direct relationship, right? You know, if we'd said, consumption and investment go down, then aggregate demand has to go down. And we know that if aggregate demand goes down, what happens to the total amount of output in the economy, right? This is something, again, we learned in Unit 7. So this is really cool because the piece is fitting. If aggregate demand goes down, then output falls, right? The amount of output falls. If aggregate demand goes up, output goes up. We did this a long time ago. Different unit. Hopefully you were paying attention. Now, the last part is the goal, unemployment rates and inflation rates. So let's just quickly draw a little picture here, right? Remember this and this haunting little picture. And we've got SRAS, and we've got aggregate demand and LRAS. And we'd say if aggregate demand goes up, right, we know output went up. And if output is rising, we know that more people are getting jobs. And so we'd say unemployment will go down when output is rising, and unemployment will go up when output is falling. And so in this example, right, we went from YF to Y1, output increased, that's aggregate demand going up, so output rose and unemployment fell. But what happens to prices? Well, when aggregate demand goes up, prices go up. And when aggregate demand goes down, right, prices go down. So we can basically see this and say, okay, if output goes down, we know that unemployment's rising and prices are falling. And if output goes up, we know that unemployment falls, but prices go up. If output goes down, unemployment goes up and prices go down. If output goes up, we know that unemployment and prices go up. So this is where we can actually observe. Like if the Fed was looking around and going, our mandate, full employment, stable prices. And if the Fed's like, prices are getting too high, got to step in. Well, they've got some tools in their toolbox and they just work backwards from this. And they say, if the goal is to push prices down because prices are too high and they want price levels to come down, what can they do? They can sell bonds to banks and make the money supply smaller. That's how this whole process works. Now, oftentimes on a test, you're going to get a question that'll say, the economy's in a recession. What should the Fed do? So if the economy's in a recession, the goal is push output up, right? We're in a recession. The goal is push output up. So what do? They buy bonds, make the money supply bigger, or they could cut the discount window rate, or they could lower the reserve requirement. They did all three of those things during the pandemic. They bought a ton of bonds. They cut the discount window rate all the way down to zero, actually, and they made the reserve requirement zero. They pulled out all the stops in the arsenal. All the tools in the toolbox came out for the pandemic. And they did the same thing during 2008. So the goal was push output up, right? Push output up. If that's the goal, you buy bonds, you cut the discount rate, and you cut reserve ratios. And you do it all and you do it fast. And that, the risk is that you might have higher prices. So right now, if you do some Googling, I bet you can find there are people at the Fed who are like, did we do too much too fast with the pandemic? Have we done too much? Are we going to push prices too high? There's your task. Go check that out. Hopefully this helped you. I'll see you next time.